Today is Tuesday, May 31st, last day of the month, day after the Memorial Day holiday. I want to take a look at moving averages crossovers, especially the death cross and golden cross. A lot of hoopla over that. The media loves to trumpet when they're about to happen or they have happened. But are they meaningful? Take a look at the Russell 2000 right here. You can see that, depending on your point of view, actually there is no question here. This is a bullish cross of the 50-day simple moving average over the 200-day simple moving average. So, golden cross, positive moving average crossover. You'd say, okay, that's a buy signal. Well, is it? Well, did that work as a sell signal when it crossed the other way in the death cross? Look at the day it crossed. Right around here. Was that a good sell signal? Probably not. Now, there's school of thought, and I've seen this a lot, where the market retraces, tests the average, and then falls. So that would be your sell signal sometime after the actual moving average crossover. You wait for the retracement. Because a lot of times you get this big sell-off that causes the crossover, and then you get the retracement. So that's one school of thought. So if that's the case, so we have the crossover here, you might expect, I don't know, the timing won't be a couple of days or today or a week, doesn't matter. You'd expect some sort of pullback, and that would be your buy signal on the crossover. That is, assuming that these are valid signals. Let's go back in time. This is still a Russell. Look what's going on in here. Flat market moving averages are useless. Lots of crosses, lots of bad signals. We keep going back in time, and you say, well, this is a pretty good signal right here. Summer of 2012. Okay, can't argue with that. But then look what happened. You're still in crossover mode, and now the market's at a net loss before the rebound. So look at these signals. They're just not great. Not great over time at all. I'm going to go down to the S&P 500. This is where the moving average death cross, golden cross work is done. And let me just get more data in here. And you can see it's just been a lousy signal. That was supposed to be your sell signal, and it happened down in here. Obviously not a very good one. There's your buy signal followed immediately by a sell signal. So lots of whipsaws. If we go back in time, say, well, this is a pretty good run. Well, yeah, it was. It happened. Sometimes it works nicely. But look what happened before it. Just whipsaws, whipsaws. Okay, now what I'm going to do is I'm going to change these to exponential averages. Maybe that'll help us out a little bit. Edit 200, just going to click over here, change it to exponential. Draw, and do the same thing for this average. Oops, my mistake. Same thing for this average. Alright, go back to current trading. Well, it didn't help much up here. Let's go back in time. You say, well, this is an awesome signal at the end of 2011. Well, yes it was, but look what it followed. A loser. Possibly a good signal, but look what preceded it. More losers. Alright, so you say, why did you go to exponentials if they're still losers? And the answer is when this thing was just catching fire as a signal. Because in here, we had whipsaws on the simple averages, but on the exponential averages it was better. And it was pretty special right here in 06. This was definitely a whipsaw on simple averages, much better in exponentials. Alright, so we tweaked it a little bit. It's a little bit better. But I'll go back to the present and say, or ask, is it? Really isn't any better. So even when we go back in time, there's the bull market, here's the last bear market, cyclical bear market. Here's a near miss right here, exponentials kept you long. So that looked pretty good. And the further back in time we go, the better this signal seems to be working. Okay, whipsaws do happen, you can't help it, but it wasn't much of a loss there, not too much damage. Look at this. So going back in time, it was pretty awesome. Well, until it wasn't. Alright, so the moral of the story is that don't believe these signals blindly. They have their merits. It's certainly better for the 50-day to be above the 200-day in terms of being long the market. But don't go to the signals. Maybe you'd want to tweak them a little bit, wait for a pullback or a retracement, or just think that things work, then they don't, then they work again, and then they don't work again. So the trick is to try to understand the market environment of where it might be working. So to say that the Russell's about to have a bullish crossover when the S&P looks like this, I would say right now is not the time where these moving average crossover signals are valid. Possibly in a year, 2 years, 6 months, I don't know. But right now I would just look at other indicators and not really get too excited about these crossovers.